Welcome to Talking Business, a podcast produced in Melbourne, Australia. The podcast is available on the Acast site, mine website, the Apple Podcast Store, or wherever you go to get your podcasts. Or you can get it at the Business Acumen website at www.businessacumen.biz or at Banking Day. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com. I am Leon Gettler. My job is to review and monitor the week's news in business, finance and economics. I bring it all to you every week. This is episode number 29 in our series for 2024, and today's date is Friday, August the 16th. First, I'll be talking to Nexia Australia's corporate advisory partner, Brent Goldman, about the latest M&A trends, which overseas countries are the largest acquirers of Australian companies, and M&A trends looking forward. And I'll talk to economist Saul Eslake about Australia's inflation outlook, its economy, and the RBA. But first, let's talk to Brent Goldman.
Well, Brent, what are the trends driving M&As in Australia for the next few years?
Yes, Leon. So we've just released our quarterly report on the M&A sector, mainly on the mid-market. And within that, we've been seeing a continual trend over the last 12 years of reduction in announcements of new transactions. And we're sort of seeing that trend to continue. And that's largely being driven by macroeconomic conditions, so interest rates, inflation, and the like, and also very much so the political landscape at the moment with election cycles in the majority of the world, creating more uncertainty and reducing transactions.
So all of that's working together.
It is, and it seems to be continuing. I guess we've had a fairly big week in those kind of areas. But I mean, on the flip side of that, I guess the other side of things we see on the positive is there's been an increase in private equity transactions over recent years, and those all have a cycle of having to exit. So, and you're starting to see that now. Even today, actually, I was looking at recent announcement news releases, and a number of private equity houses are looking for buyers for their assets. And you also, particularly in the mid-market, that constant search for growth, which continually drives companies to look for mergers and acquisitions to boost their businesses. And along with that, the other areas we are seeing, particularly, I hate using the word AI because it seems to be used all the time, but there are, let's call it buying in skills, one of which is skills around that area, as well as the ESG side, which is also another buzzword I hate, but it is a reality, and people are buying in various services and skills and products to expand their offering there as well.
That's interesting because Australia only has something like 33,000 experts in AI, I was reading.
I actually didn't know that number, but it's, I mean, clearly there's been, well, I've always had this thing where I think Australia punches above its weight as well, even with those small numbers. And you do see it. I mean, like if you look at overseas companies coming in here, the US always buys in Australia, and they've been a consistent purchaser of companies. And a lot of times that is in the software services type industry. So there's definitely an ongoing buying of businesses with skill sets and recognizing the talent we do have in Australia, really.
And also integrating their services and their skills with our companies.
Correct. Yeah, just to make something bigger. I mean, look, it's one of those, it's interesting. I always look at it, and I think we have a limited resources in Australia, so we're always trying to find solutions to problems. And so we end up finding smaller companies with skill sets to solve problems which larger companies just cannot do. And that's just, I think, a nature of our culture and also our education as well.
The M&As are going on mostly with software companies. Is that what you're saying?
Actually, the most active sector is the industrial sector in the last quarter, and that was across a range of industries, a lot of professional services, but in particular, construction and engineering. There was a number of transactions there. You could probably see that potentially as defensive. I mean, that's an industry that's been struggling a bit. Then the next bigger sector is in information technology, and that really was in software services. Actually, rather than AI, it was actually more around cyber security companies, where the main ones there in the last quarter. And then the third biggest sector is consumer discretionary, and that was actually pubs. So a lot of pubs trading hands in the last quarter. So.
Right. And interestingly enough, mining doesn't seem to come into it much.
No, the mining is always there, but it's not so much in the M&A activity we've noticed. I mean, it's always floating around. Actually, if you went and flipped into the mid-market IPO sector, the mining is probably the only place where there's any real activity at the moment. And it tends to float around more in that space, but not so much in the M&A space in the recent quarters. I'd say probably if you look back 12 months ago, there was a lot more activity in that space.
So you're saying the US is a big acquirer of Australian businesses. Are there other countries?
Yeah, look, consistently, the main countries that buy, and I'm talking about mid-market Australian companies here, are US and UK companies. I think about 38% of acquisitions in the last quarter, and it seems to be pretty consistent where our overseas buyers of Australian companies. So there's still a large domestic amount of transactions, and of those, 32% were US buyers and 17% UK buyers. So they're fairly active. I mean, nearly half come from those two countries, and that's always consistently the case in the acquisition of companies anyway. Assets slightly different.
And so, what's the trend like with assets?
I haven't got all the data. We don't sort of monitor that as much, but just anecdotally, you tend to then see a lot more coming then from China in particular. You're talking agricultural assets, mining assets per se. Coming back to that mining point, they tend to be more asset acquisitions rather than corporate acquisitions. So
Yeah, countries that need it.
Correct. Yeah. And then bring it into their supply chain, etc. Yeah.
Of course, absolutely. Now, these US and UK acquirers, are they what, private equity? Are they listed companies or what?
It's a real mix actually. So it's corporate is the main part. So back to what we were talking about before, buying in skills and products and services that they don't have. And look, a lot of these overseas acquisitions are all in software services or media and entertainment. So you can see the similarities between the countries as well, which kind of drive potential synergies there. But a lot of it's actually more corporate buyers, I have to say, in that mid-market space. The odd private equity deal, but often those corporate buyers are backed by a private equity company in those countries as well. So yeah, look, I mean, you do have that element of, for the most part, private equity houses particularly in the mid-market space, are mandated to invest domestically. So when you do tend to find them coming into Australia, that tends to be through one of their investee companies rather than directly.
And of course, their aim is to just build the company up and then sell it for a profit.
Correct, which comes back to that trend where, as that's been a fairly active area of the market for the last few years, we're starting to have to think about, well, how's that exit profile going to work for all the private equity companies, and increasing supply, if not demand, for M&A activity in the mid-market.
So what are your projections for the trends ahead, looking forward to, say, 2027?
Yeah, look, I wish I had a crystal ball to see all that all the way through to there. But I mean, I can say, I think, really starting with the short term, the next 6 months or so, we're sort of expecting a continuation of the current trend, activity, but relatively flat, and transactions taking a bit longer as everyone tries to deal with the uncertainty in the background. These things, I always think about it as the human nature eventually, particularly in this space where you've got a lot more entrepreneurial businesses as well, and owners and companies that really want to drive. They'll eventually need to start moving forward again. And so I think once we get through this next 6 to 12 months, and I'm hoping full in the new year, we'll start to see activity pick up as we put a lot of the uncertainty behind us. Whether you like what's going to happen or not, it's at least you'll be able to make some decisions with some certainty or stronger views. And then, as I said, we'll have the issues of the private equity exits. And look, I mean, the other side of that is, there's a bit of green shoots in the capital markets starting to pick up again, which also increases confidence. So going forward beyond this period, expect to see growth again, as you always do after a quieter period.
And of course, within the next 12 months, we're going to see movement on issues like, say, inflation, hopefully interest rates, and hopefully the sequence of political events will have quietened down by then.
Exactly, and then that just creates a bit more comfort for everyone to move forward. I mean, I think it's been interesting up until this point, where even though it was quiet, because you had such diverse opinions, you almost had markets being made by half the population thinking the world's going to end, and half the population think it's going to be fantastic. So it creates a place where people can come together. I think just it's dragged on a little bit too long, and with everything else happening this year, it's kind of created a bit more uncertainty. But as I think that starts to unwind, people have views, and they'll be still very diverse views, but that diverse views does help create transaction.
Okay, so we'll watch that very closely for the next 12 to 18 months. Would that be right?
I think that's fair statement. Yes.
Yeah. Well, that'll be fascinating to watch, Brent.
Yeah, no, it will be. Hopefully, for all and the concerned, it starts to settle down.
Yeah, and it'll certainly give you a very busy time looking ahead.
Yeah, but it's probably more bigger than that. It's about the economy and people and jobs, and creating that level of activity so that people feel confident to start transact again and building businesses, and that just creates opportunity for all, really.
And the big issue here there is who can predict?
That is the big issue.
Well, Brent, it's been fantastic talk to you. Thank you so much for your time.
Thank you. Thanks for having me, Leon.
Thank
Good
you.
to speak to you.
And now let's talk to economist Saul Esley.
Well, Saul, what did you make of Australia's inflation figures? And the markets are now going crazy as well.
Well, I think we dodged a bullet with the inflation figures that were released in the last week of July. Inflation has been coming down more slowly in Australia than the Reserve Bank had expected, and more slowly than in other comparable countries. There'd been some speculation after the release of the April and May monthly inflation data, which only give a partial picture of movements in the more authoritative quarterly consumer price index, that the June quarter figures could have forced the Reserve Bank to raise interest rates at its board meeting that's being held this week after we recorded this interview. But mercifully, although headline inflation came in at 4%, more or less in line with expectations, the Reserve Bank's preferred measure of underlying inflation that strips out the more volatile components of the consumer price index came in at 3.9%. That was just marginally below market expectations. And although it was 0.1 of a percentage point higher than the Reserve Bank had most recently forecast in May, that I think won't be regarded by the Reserve Bank as material enough to prompt them to depart from the strategy they've had in place since late last year, which has been, as they've since then formally acknowledged, to tolerate inflation being above its target for longer than its peers in the US, Canada, the UK, and New Zealand have been willing to tolerate inflation being above their respective targets, which are a bit lower than the Reserve Bank, in order to preserve as much as they can of the gains that were made in reducing unemployment and underemployment to levels that had previously been thought unattainable in the years immediately after COVID. Now, some people are critical of that choice. I'm not, but it does mean that because the Reserve Bank was slower than its peers to start raising rates, and because it's raised them by, in some cases, significantly less than its counterparts in the US, the UK, Canada, and New Zealand, inflation won't come down as quickly here as it has in those countries. And as a result, interest rates won't come down as quickly as they're now starting to do in some of those other countries. You know, we've already seen the Bank of Canada, which raised its cash rate to 5%, cut it twice in the past few months to 4.5%. We've seen the Bank of England, which raised its cash rate to 5.25%, cut its last week to 5%. It's now highly likely that the Federal Reserve, which raised its cash rate to 5.38%, that is a full percentage point higher than here in Australia, will cut rates at its next meeting in September. And in the aftermath of the higher than expected unemployment figures for July released in the US on the first Friday in July, there's now a lot of speculation that the Federal Reserve will begin by cutting its cash rate by half a percentage point rather than the normal quarter of a percentage point.
That said, 3.9% is still way above the 2 to 3% target range.
Absolutely it is. And that partly reflects the fact that the Reserve Bank has chosen not to go as hard in crushing inflation through tight monetary policy as its peers, the Federal Reserve, the Bank of England, the Bank of Canada, and the Reserve Bank of New Zealand have been willing to do. And some of those countries have paid a higher price in terms of unemployment than Australia thus far has. For example, in Canada, the unemployment rate reached 6.8%. in June, having risen from 4 point something in the middle of 2022. That's a much bigger increase than has occurred in Australia. Similarly, in New Zealand, the unemployment rate has risen by more than a percentage point, and probably would have risen by even more than that, except for the fact that, as always happens when the labour market in New Zealand softens, some New Zealanders come to Australia looking for work rather than staying in their own country. The reverse typically doesn't apply. So Australia's done, I think, quite well in keeping unemployment down. Unemployment has risen, but it hasn't risen because people have been losing their jobs. It's been because there's been a flood of people looking for work, especially coming here from overseas. and not all of them have been able to find it as quickly as they had been able to during 2021 and 2022. But as I say, it's the inevitable corollary of the fact that our central bank has been slower to start raising rates and has raised them by less than its counterparts in other comparable countries, that it will be slower to start cutting them than those other central banks have been and will be.
Some of the banks here are projecting that if this disinflation here continues, that the RBA will start cutting rates in November. I suspect your view would be more that they'd probably start cutting probably in February.
Yeah, that has been my view since November last year, that the Reserve Bank would not cut Australian rates this year, even though I'd expected, as has turned out to be the case, that many other central banks would start cutting rates this year. The Reserve Bank, I think, will need to be much more confident that it can be now, or that it's likely to be over the next 3 or 4 months, that inflation will be sustainably below 3% by the end of next year in order to begin to start cutting rates. Now, let's be clear, inflation doesn't have to be back to their target range or to the midpoint of their target range. That's 2.5% for them to start cutting rates. Monetary policy works with a lag, and the Reserve Bank has to anticipate what it thinks will happen to inflation in deciding when and what to do with interest rates. They can't wait until inflation is at 2.5%. That would result in an unacceptably high risk of unemployment rising more than it objectively needs to bring inflation back under control. But I think they need to be more confident than they can be at present with the underlying inflation rate at 3.9, that it's going to drop by a full percentage point over the next 12 to 15 months. I think there's a reasonable chance that they will have the required degree of confidence by early next year, but I struggle at the moment to think that they will acquire that degree of confidence over the next 2 or 3 months, unless it turns out that the world economy is headed for some kind of serious economic downturn, which in the past few days, some people have begun to worry about. My view is that while you can't completely rule out that possibility, what we've seen in financial markets over the last few days is more to do with the unwinding of highly leveraged positions in, for example, tech stocks and in some currencies and in the Japanese stock market than it is telling us something fundamental about the state of the economy.
So this view that the stock market is reacting to these fears of a recession in the US and underwhelming corporate earnings, that's overstated.
Well, I think it's certainly telling you something about what markets had been expecting. For example, for the profitability of artificial intelligence and the like, there have, I think, been elements of the mania that preceded the tech wreck of March 2000 in what's been happening in some tech stocks in the United States in recent months. Likewise, we know, although as Warren Buffett famously said, it's only when the tide goes out that you get to see who's been swimming naked, but it's now clear that there had been a considerable volume of highly leveraged speculation in the so-called carry trade, borrowing in yen to invest in US dollars, profiting from US rates being higher than Japanese rates, and from the resulting appreciation of the US dollar against the yen. Well, with the Bank of Japan raising interest rates last week by 15 basis points for only the second time in 2 decades, and signalling that there will be further to come, whilst in the aftermath of Friday's employment numbers in the US heightened expectations that the Fed will cut sooner and by more, that carry trade is now being powerfully unwound. With the yen rising sharply, the bets that many people had made on the profitability of Japanese exporters are also starting to be unwound, which is why the Japanese market has fallen so much further than markets in other countries. In some ways, I think these events are reminiscent of the market turmoil we saw in March 2023 around the collapse of Silicon Valley Bank and a couple of others. These were significant events for financial markets, but they didn't presage a serious downturn in the US economy. Today, there is clear evidence that the US economy is slowing, as you would expect after almost 2 years, with interest rates at their highest level in about 30 years. You would expect to see some slowing in the US economy. The surprising thing, if anything, is how long it's taken for the US economy to slow. But at this stage, I would say that fears that we're on the brink of another US recession are overblown.
And indeed, it's quite extraordinary that although profits are down in this reporting season in Australia, they're still showing Australian companies are still pretty resilient despite everything.
In most sectors, they are. I mean, the mining sector in particular is doing very well. Banks are doing very well. There are some sectors that are struggling, retail and construction in particular, where we've seen the highest level of bankruptcies and insolvencies in the construction sector for well over a decade. There are parts of the economy where the corporate sector is not doing well. And of course, a large proportion of households are under considerable financial pressure as a result of ongoing increases in the cost of living, especially for essential items. And for those roughly 1/3 of households who have mortgages, and especially the quarter of households who have very big mortgages, they're under quite significant financial pressure and having to cut back their spending. So the Australian economy is treading water. If it wasn't for the rapid population growth we've had over the last couple of years, we would have had what the media would have called a technical recession. We've had 4 quarters in a row of negative growth in real per capita GDP. That's up to the end of the March quarter. When the June quarter figures are released early next month, they'll probably show a 5th consecutive quarter of negative growth in real per capita gross domestic product. But again, that shouldn't be surprising in the face of the high interest rates that Australians have been experiencing over the last couple of years.
Well, Saul, as always, it's fantastic talking to you, and thank you so much for your time.
And that's a pleasure, Leon. Talk to you again soon.
So what's happening in the news? Well, Bruce Daisley, former Twitter's vice president for Europe, Middle East and Africa, says Elon Musk should face personal sanctions and even the threat of an arrest warrant if found to be stirring up public disorder in the UK on his social media platform. The UK government has called on social media platforms to act responsibly after violent unrest swept through the UK following the fatal stabbing of 3 young girls at a Taylor Swift-themed holiday dance in Southport last month. The Prime Minister has blamed social media companies for allowing the spread of false claims that the attacker was an asylum seeker, and police are increasingly going after those suspected of using online posts to incite violence. In one post, Musk wrote, "Civil war is inevitable in the UK," language that the Justice Minister Heidi Alexander described as unacceptable. Musk has also shared a false post suggesting Labour leader Keir Starmer was planning to set up detainment camps in the Falkland Islands, a post he later deleted. Daisley, who worked at Twitter, now X, from 2012 to 2020, describes Musk as someone who has taken on the aura of a teenager on the bus with no headphones, creating lots of noise. He said, "Were Musk to continue stirring up unrest, an arrest warrant for him might produce fireworks from his fingertips. But as an international jet setter, it would have the effect of focus." Reserve Bank Deputy Governor Andrew Hauser has warned against overconfidence on the outlook for interest rates while outlining two-way risks for unemployment and household consumption that could affect the outlook for inflation. In a speech to the Economic Society of Australia in Brisbane on Monday, Mr Hauser said anyone claiming that interest rate prescriptions were obvious were false prophets. Mr Hauser, who joined the RBA in February after a distinguished career at the Bank of England, said that Australians are right to want to be confident that the central bank will bring inflation back to target and maintain full employment in accordance with its dual mandate. That is the RBA's mandate, and we should be held to account for it, he said. But the policy strategy required to deliver that outcome and the economic judgments that inform it simply cannot be stated with anything like the same degree of certainty, he added. Those pretending otherwise are false prophets. The RBA board, led by Michelle Bullock, left interest rates on hold as expected after its August meeting last week. Mr Hauser said the RBA must guard against overconfidence in its outlook for economic demand. In its latest statement on monetary policy, the RBA considered alternative scenarios and the potential for potentially sharp changes in behaviour. Assuming that unemployment rises only gradually, the central projection is for consumption growth to pick up in line with an expected recovery in household real incomes, he said. Consumption also depends on the extent to which households choose to spend or save these higher incomes, and we are much less confident in that judgment. And technology companies say job graduate readiness is at its lowest levels, with most believing 99% are not able to jump in and perform effectively after leaving university. Just 1% of graduates can hit the ground running across Australia, a figure that's dropped 2% from last year, and this is leading some employers to look offshore, according to Australian Information Industry Association's State of the Nation's 2024 report. AIIA Chief Executive Simon Bush says that most tech companies found graduates needed at least half a year to reach a level where they were productive. 6 to 9 months of training is what's required. At least that's the feedback from our members to train university graduates and get them job ready, he said. Obviously, we've got a very small to medium enterprise heavy economy, and SMEs cannot afford to bring someone in that's unproductive for that period of time. Vietnam has for some time been rising up to meet Australia's tech worker shortages, with a report released in February this year finding hiring from the Southeast Asian nation had grown 126% over the past 12 months. Vietnamese recruitment firms say that many workers have found Australian working conditions, even on remote contracts, are more generous than those from the USA and Korea. Mr. Bush said while AIIA's new report showed that most overseas workers were being hired on remote contracts, occasionally those with highly sought-after skills were being sponsored and brought into the country. The AIIA wasn't against the hiring of remote offshore workers, but said the association had a preference for hiring in Australia. And the Albanese government plans to reduce the number of online gambling ads, but it has exempted Google's lucrative search engine. Wagering firms will still be able to buy sponsored results on some search terms. The government plans include a ban on gambling ads, an hour either side of live sport, no more than 2 ads per hour on TV until 10 p.m, and a blanket ban on betting ads on social media and other digital platforms. However, it does not prevent gambling companies from advertising on sports jerseys or on signs in stadiums, both of which appear on TV broadcasts. As for Google, its search results fall into 2 categories, organic and paid. Organic results are based on how relevant a website is to what a user has searched for. Paid results are listed as sponsored at the top of some search terms. Banks, for example, pay to appear at the top under the search term home loans. Google's search platform has a carve-out for wagering-related terms. Search is a huge money spinner for Google. According to digital advertising group IAB Australia, search engines made $6.6 billion in Australia in 2023. Google commands a lion's share of the search market. Revelations there may be carve-outs have triggered fury among independent MPs who have demanded a total ban. Anything short of a blanket ban will just move ad revenue around, as we saw with tobacco, Teal independent Kate Cheney said. A carve-out allowing sponsored content on search engines would be the thin end of the wedge. Fellow independent MP Zoe Daniels said gambling companies would take every loophole they are given. In this case, it may well be the most vulnerable who are likely to search gambling terms who are then targeted with ads, she said. Surely this is unconscionable. And Woolworths has moved into the vegan meat industry, signing an exclusive deal to stock discount options that undercut the struggling startups once dominant in the market. In May, the supermarket behemoth started selling products from Melbourne manufacturer Flexitarian Foods that retail for about half the price of offering from vastly smaller rivals. The move mirrors a trend in Europe where supermarkets such as Germany's Lidl are selling home-brand fake meat products after businesses hoping to become brand names in the sector, such as venture capital-backed Sunfed and Proform Foods, collapsed. Plant-based food startups enjoyed a boom until 2020, as investors piled money into the sector, hoping it would attract customers willing to swap out meat for ethical reasons, even if it cost a premium. But the sector has grown at a far slower rate than expected. Woolworths says demand for plant-based meat had grown 50% in recent years, off a low base, then softened but bounced back in the last 2 months. It claims plant-based protein products, which seek to recreate the traditional meat-eating experience, are proving more popular than vegetable-based products like veggie patties. Premium plant-based meat maker Vow is making high-end creations like parfait. Though the company is not profitable, Vow's co-founder and chief executive, George Pepu, says Vow has significant financial reserves. It hopes to hit the high end of supermarket pricing within 2 or 3 years, he said, but would not necessarily sell through that channel. And REA, which owns property listings platform realestate.com.au, extended its lead over Domain at its annual results on Friday and has been handsomely rewarded. The $460.5 million in net profit was well below expectations, but shares rose almost 7% with guidance of ongoing strong listings numbers. REA, which is majority owned by Rupert Murdoch's media company News Corp, has grown its market capitalisation to $26.7 billion, up more than 10% since January. It is worth more than Coles. Domain, meanwhile, has fallen 10.8% over the same time, taking its value down to $1.9 billion. The longer-term trend is just as poor. Over the past 5 years, Domain, which is majority owned by Nine Entertainment, has added 11.3% to its share price. Nine's 60% stake in Domain is worth $1.6 billion. Nine's current market cap is $2.24 billion. REA is up 109%. Decent proxies for changes in market share are app downloads and monthly active users. According to analysts at investment bank UBS, REA's monthly app audience rose 9% in July year-on-year versus Domain's 7% decline. In February's half-year results, Domain lost ground on the number of property listings available. Brokers say this has narrowed in the second half, but also say it should reinvest recent cost cuts to close what has become a record difference in valuation to REA. On Friday, Domain releases its full-year numbers. Every result is important, but the cliché critical juncture seems very appropriate. Domain's potential is clear. Private equity firms KKR and TPG have been circling. Nine's bankers gauged their interest in Domain last year. TPG has kicked the tyres and has swung at buying Domain back in 2017. Nine's board has periodically pondered the merits of taking full ownership. Former Nine chairman Peter Costello was no fan of Domain's performance, or chairman Nick Falloon, but nothing was done. Nine's new chair, Catherine West, has quickly cemented herself in the role, touring the country's news floors and offices to meet key decision makers, and Domain's long-term leadership must be right up there on her list. More than half of Domain's $2.2 billion valuation is down to its ownership of Domain. And Rupert Murdoch's News Corp has put Australian media company Foxtel up for sale as the global publishing and broadcast giant confronts the reality that streaming is rapidly bringing the era of pay TV dominance to an end. On Friday, News Corp flagged third-party interest in the group, in which it owns 65%, and brokers point to Platinum Equity, a major LA-based investment firm, as a likely buyer. News Corp Chief Executive Robert Thompson told analysts that News Corp had a significant overture that we're naturally assessing, but declined to provide further details. The sale could value the business at $1 billion and comes in the same week that big broadcasters Warner Brothers, Discovery and Paramount Global had more than US $15 billion, that's $22.8 billion Aussie, wiped off the value of their cable TV networks. Foxtel's streaming platforms Kayo and Binge have much leaner profit margins. The challenge for News Corp has been to preserve Foxtel's legacy base of 1.2 million subscribers who pay on average $90 a month and are responsible for most of the profit. They are diminishing by about 10% a year, including streaming and cable. Foxtel has grown its total paying subscription base to 4.7 million people. Any sale of Foxtel would have a flow-on effect on long-term content deals, multi-billion-dollar sports rights packages and more. And Australia's corporate regulator needs a US-style law enforcement approach. The architect of the latest inquiry into the country's Business Investigation Agency has warned, saying its current model is unworkable. Liberal Senator Andrew Bragg, in his first interview since publishing his 206-page review of the Australian Securities Investments Commission, says the regulator needed a new direction if it were to achieve better enforcement outcomes. His view has been backed by a coterie of former regulators and corporate figures who said ASIC's mandate was too broad and the agency inadequately funded, and urging consideration of a breakup. Bragg, who chaired the latest inquiry into ASIC, called for the agency to be split between a company regulator and financial conduct authority. Bragg said ASIC should be split into two agencies, one which handled business administrations, liquidations and registration, and another to deal with the country's financial sector. This could see Australia adopt a British-style model, spearheaded by their Financial Conduct Authority. Britain split its super regulator in April 2013 into the FCA and Prudential Regulation Authority in the wake of the global financial crisis. ASIC, the corporate regulator, is charged with upholding Australia's corporate laws and taking enforcement action against lawbreakers and business figures. It can take civil or criminal action. The Commission, formed in 1998 in the wake of the Wallace inquiry, has faced criticism over its enforcement record and failure to tackle major breaches. Senator Bragg said it is time to consider a split of ASIC, saying the regulator had shown a failure of leadership and there had been some poor appointments, and calling for a new approach to governing the agency. By contrast, the Securities and Exchange Commission, America's corporate law enforcement agency, operates as a market-focused entity. It is credited with an aggressive enforcement culture and fast results, and is able to hand whistleblowers a fee for high-quality information. Bragg said ASIC or any enforcement agencies should achieve more Sam Bankman-Fried-style outcomes with a quick turnaround between charges and jail. They need to drive a culture of fear of law enforcement, he said. And the profit reporting season continues. Commonwealth Bank, Australia's biggest bank, reported a $9.8 billion cash profit for the year to June 30, down 2% on the previous year. Seven West Media reported a profit of $45.3 million, 68.9%. AGL Energy reported a statutory profit of $711 million for the full year, from a loss of $1.3 billion a year ago. Imaging technology company Pro Medicus posted a net profit of $82.8 million for the 12 months to June 30, 36.5% higher than the year earlier. Glass bottles and can maker Aurora's net profit inched ahead by 0.2% to $185.2 million for 2023-24. Evolution Mining posted net profit, statutory and underlying, of $422 million and $482 million, up 158% and 135%. Online vehicle marketplace business Car Group posted a net profit of $250 million, down from $646 million a year earlier. Beach Energy posted a net loss for the year ended June 30 of $475.3 million, down from net profit in the 2023 financial year of $400.8 million. JB Hi-Fi's profit fell 16.4% to $438.8 million. Rail haulage group Horizon reported a 25% rise in annual net profit to $406 million. CSL reported a 20% increase in full-year net profit to US $2.64 billion, that's $4 billion Aussie, boosted by exceptional growth in immunoglobulins business. Wealth Challenger posted a 24% decline in full-year net profit to $134 million. Online recruitment platform Seek reported a 13% drop in earnings to $483 million in fiscal 2024 from a year ago, as job ads fell across the Asia-Pacific region. Building products group James Hardie posted a 1% lift in its first quarter adjusted earnings to $236 million. Online retailer Temple & Webster reported record revenue of $498 million for the 2024 financial year, up 26% on the prior year. The country's biggest owner of suburban malls, Region Group, has posted a statutory net profit of $17.3 million. Fund manager Netwealth's statutory net profit leaped 24% to $83.4 million in fiscal 2024. NBN Co. reported a loss of $1.176 billion, which was worse than the $1.19 billion the previous financial year. Bunnings landlord BWP Trust has turned in a $180.2 million profit for the 2024 financial year, up from last year's profit of $36.7 million. Car equipment company Emotive posted a $100 million statutory net profit in fiscal 2024, a 6.5% gain from a year. And that's it for this week. And next week I'll be talking to the Director of Work for Climate, Lucy Piper, on the issue of how many of Australia's leading companies, Telstra, Rio Tinto, Qantas, Woolworths and more, are obstructing and delaying Australia's transition to net zero by lobbying against climate action. And I'll talk to Indeed economist Callum Pickering about the latest unemployment figures. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com. If you like Talking Business, please leave us a review with Apple Podcasts. Thank you in advance. In the meantime, you catch me on Facebook, Twitter, Instagram, LinkedIn and YouTube. If you want to contact me, email me at leon@leongettler.com. I answer all emails. Also, in my copious spare time, I have a copywriting business. If anyone needs newsletters, blogs, articles or advertorial, email me. Wishing you all a safe and healthy week and looking forward to bringing you Talking Business next week.